We spend so much of our time focusing on and analyzing the prospects for a downturn or a recession or market volatility and disruptions. We don't give enough thought to how do those become a contraction, or more importantly, the aftermath. How do we get from where we are today to where the markets are pricing tomorrow might be? What are the mechanisms involved from, say, deflationary monetary outbreaks to become a long-run future? If we were to see something like April again, what might happen from there? It's a question that comes up all the time. How does, say, a real deflationary outburst really damage the real economy? It's not immediately clear what the mechanism is, therefore what we should be looking for. Moreover, we aren't necessarily talking about something like a complete meltdown either. We don't have to see a rerun of 2008 in order for there to be negative consequences that lead to a future like what the swap market is pricing. The world doesn't necessarily have to experience widespread bank failures for deflationary conditions to create big and lasting problems. But how does that happen? Monetary circulation gets disrupted, but then what? And so while we aren't expecting a repeat of the 2008 crisis, looking back on it can shed a lot of light on these mechanisms. How monetary system disorder gets to be such a drag on economic operations that not only does the economy suffer in the short run, the negative effects can linger onward for a long time afterward. So swaps, forward rate curves like SOFR futures, even the plain vanilla cash yield curve, all of them are pointing to a future where interest rates go down by a lot, and then stay there for a long time. Deflationary outbreak would be perfectly in line with getting to that point, but how does that happen? How does it materialize? What are the mechanisms behind depression economics? First of all, the entire mainstream is, as usual, focused on inflation. The reason is simple, and it's not actual inflation. We get all our ideas, interpretations of the economy, and the risks to it from one single source, the Fed, or the ECB if you're in Europe. However, the monetary system itself, the biggest parts of the financial economy, don't actually listen to the Fed all that much, if at all. Traders do, sure, those especially working in the front parts of these various curves, but the big money, not only does it not follow the Fed, more often than you think, it bets directly against the Fed's position. Or in more extreme cases, those wagers are taking the other side of Jay Powell, and they can become extreme. And this is one of those times. Since April, swaps, forward rate curves, the yield curve too, they have all increased positions against inflation, wagering more confidently that rates will keep going down and go down by a lot. And a deflationary outbreak would be one clear way for rates to go down to stay there. But not just a deflationary outbreak, the macroeconomic consequences from a deflationary outbreak. And that leads us to this question: how does the one become the other? How do we get from a deflationary outbreak to an economy that generates interest rates that go down and stay there for a long period of time? What are the mechanisms involved here? So as the marketplace isn't betting on anything like tariff inflation and a whole lot on possible and potential deflation and economic contraction, it is important and in fact vital to understand what it is that the one becomes the other. Now, to be clear here, the deflation that we're talking about is an interruption in the flow of money, credit, and collateral. When especially collateral stops flowing, the money and credit get turned down very shortly thereafter. So that interruption then creates negative consequences in financial markets, and they call it volatility, like we saw in April. But it also leads to economic problems too, both for the short run and the long run. And we've seen this before in these same key markets, going back to 2008. The swap market in particular made a big, bold move in 2008 and 2009 that came to be true. During the deflationary meltdown in late 2008, while everyone else was going crazy for QE and ZIRP, zero interest rate policy, swaps said those were not going to work. The damage to the economy from the deflation rate then would mean rates went down to stay for the long run. And that was at the time considered to be a wild proposition. Most thought QE would go too far in the other direction, that it would be too effective, and combined with a huge fiscal stimulus, the world would be swimming in inflation by 2010 at the very latest. The government was, many said, debasing the dollar. And had there been inflation and debasement, interest rates would have risen and risen sharply. Not only that, the Fed never intended for zero interest rate policy in QE to be anything more than temporary emergency procedures. Officials believed they'd pull down the short-term policy rate and then get it to zero for a little while, but then have to raise it right back to normal at the very least once the economic recovery took shape. The monetary system itself said there was no debasement, there was no inflation, there was no recovery. Instead, the market correctly predicted the deflation of 2008 was going to lead to long-run depression economics, as seen by interest rates, which dropped to ultra-low levels, and then, against all initial predictions, stayed there for the long term. And that's exactly what happened in the 2010s. Okay, but how? How does that work? How do we go from the deflationary outbreak to the long-run bleak depression economics of the future? If you want to stay on top of everything, all of these monetary and macro developments, Eurodollar University has a brand new subscription for you over at Substack. Every week, we're going to tell you what the one big theme is that you need to know about, and then dive deep into it, giving you all the background material from all across Eurodollar University's vast library of material about what's happening, why it matters, and what it means for the future. And you check out all the details behind that new subscription service, as well as some sale items on Eurodollar University memberships at our website, Eurodollar University. There's also a link in the description of this video to go right to Substack. For the 2008 crisis and any sizable deflationary event, there are basically two main channels for it to infiltrate the economy and undermine its long-run potential. First, how employers respond to the deflation, and second, how banks do. So starting with the labor market, think about how businesses operate on the most basic level. They have working capital needs for everything like inventory management or regular expenses. Most of all, payrolls. And since revenues don't always line up with those outlays, financing working capital is a huge deal. It is essential. And that financing comes from a couple possible sources, instruments like commercial paper, though more so lines of credit with banks. In a regular downturn where revenues start to get lighter than anticipated, working capital financing becomes even more vital. But what happens if the bank shuts down your credit line at the worst possible time? Not only would you have the pressures from lower revenues, now you've got cash flow issues which become immediate. And because of them, you have no choice but to conserve cash in every way possible. Even if you were planning on holding to your workers, for example, thinking the downturn was temporary, without cash flow, you no longer have any option. To remain solvent, you've got to start slashing investments, expenses, employees. A deflationary environment makes a downturn that much more severe in the immediate case. But that's only the beginning and not even the worst part of it. Where it becomes long-run damage is in how businesses respond to that deflationary experience. They permanently alter their very behavior. They begin to hold larger liquidity cushions than they ever did before, essentially self-writing their own cash flow insurance rather than depending on banks or something like commercial paper. Think of this in a hypothetical example. Let's say you work in a high-risk industry where industries are a possibility. The money is so good, though, you take the risk. Not only that, your employer offers generous terms, ultra-generous terms if something does happen to you. Plus, it also provides you insurance that will cover basically every possible need. So you feel protected even if there are risks. But then something happens to the business. Your employer no longer offers the same generous terms in case something happens. The insurance that you thought would provide full coverage turns out it is unreliable at best. Not only that, because of what happened, job injuries are starting to become more frequent and severe than you expected when you started the job. So how would you respond to all that new information? Whereas before, you might not feel the need to save up a lot of extra cash on your own because you fully believed your employer and its insurance had you completely covered. But now that you know that's not true, you're going to start conserving as much cash as you possibly can. You're going to have to cut back on your expenses in order to do that. And even if there are things that you really might need to buy in the short run, you're not going to be able to do it. You just can't take the risk of not having a large cash cushion. And that's exactly what happened in the real economy In 2008 and afterward, the deflationary outbreak changed the way businesses behaved, and we have evidence for this all over the macroeconomic accounts. When businesses all over the commercial system realized they were being locked out of credit, they changed their operations to protect themselves. Rather than rely on banks, they began to underwrite their own cash flow protection, building up their own liquidity cushions. And while they did that, it meant they had to cut back on expenses and then continue to cut back even after the economy had bottomed out, the green shoots of 2009. Companies refrained especially from hiring like they otherwise would have in a normal downturn where banks were still providing reliable access to credit. And we have direct evidence for this all over the place. But in the labor market especially, it suffered massively because of this deflationary consequence. The JOLTS data, for example, shows us how hiring absolutely crashed during the crisis, but then it never recovered afterward. That was due to firms building up this cash savings and over-managing their costs. They refused to take risks, which recoveries require. It got to be so bad that hiring was so low for so long that millions and then tens of millions of American workers dropped out of the labor force since no one was hiring, all due to the deflationary event. By the time hiring finally began to pick up again, it was half a decade later. It was far too late. The long-run damage had already been done. It wasn't demographics. The participation problem was a deflationary consequence. This is just a modern mechanism for the destructive deflation that John Maynard Keynes wrote about over a century ago when he called deflation the worst monetary evil. Its effects are felt most by workers. In his day, the mechanism was in falling wholesale and consumer prices, leading to falling wage rates. In 2008, in the modern deflation, the mechanism is companies conserving cash, over-managing their costs, risk aversion, failing to hire back after firing. Wages don't decline like they used to. The number of workers does. But it ends up the same nonetheless. Lower wages, like lower workers, depress incomes. Depression economics. Incomes stop growing the way the economy needs it to. Incomes stop growing in the way workers need it to. But then there's the other side of this, the other channel, the other major channel for deflation, and that's in the banking and really the monetary system itself. We saw this, and we still see this to this day all over the banking system and the monetary relationships. So at the same time back in 2008 that employers were under severe liquidity strain, which caused them to change their own operational behavior, it happened for the banking sector too. If anything, the banking sector is even more directly impacted by deflationary money. Just ask Bear Stearns, Lehman, AIG, and a whole host of others back then. What makes deflation so devastating to banks is that it distorts their intermediation capacity. Intermediation means allocating money via credit, which necessarily requires risk-taking on the part of the intermediaries. And those intermediaries are banks, but especially dealer banks, who are absolutely essential to maintaining money flow. But illiquidity, it impairs risk-taking since banks have to be more defensive. It's the same analogy I used before about the worker who now has to build up a higher cash cushion, realizing that the industry is far more dangerous and the backstops that everyone thought that were there aren't actually there. And that includes the Federal Reserve, by the way. Before the 2008 crisis, many people thought the Fed was a central bank, an effective backstop in case any monetary event happened. Not only did they find out the monetary system itself was more fragile than previously believed, they also found out the Federal Reserve isn't actually a central bank. At the very least, it is not an effective backstop to the monetary system and the banking system as it actually is. So now being far more attuned to the liquidity risk that is far higher than anyone previously believed, risk-taking and the overall level of activities among banks to create money and circulate it throughout the world suffers. They naturally do a lot less. But where they do things, that also means preferencing less risky opportunities. And Ben Bernanke, in his famous 1983 paper, correctly identified what was the last piece to finally explaining the Great Depression. And yes, it took that long for that to happen, to explain everything. The deflationary money, as Milton Friedman uncovered, was only the beginning, the first major step. When the deflation got to be bad enough, as it did in the 1930s and again in 2008, 2009, it eroded the very abilities of the banking system, which is really the monetary system, since the vast majority of all money is bank money. It eroded their ability to intermediate. Banks would lend to governments and big corporations, but practically no one else. They stuck to the most liquid assets as part of their own liquidity cushions, tons of government bonds, few if any loans to small businesses or regular people. We have evidence for this everywhere as well, even if you've never seen it or heard about it. Banks loaded up on government bonds. Uncle Sam could borrow as much as he possibly wanted. Banks could not possibly say no to the government, but yet mom and pop, they got nothing. There was nothing left over for those parts of the real economy, and those parts are where economic growth over the long run actually comes from. Just look at mortgages. After the 2008 crisis, mortgage lending practically disappeared. It didn't actually disappear, but mortgage lending growth did. And this country badly needs to build more houses, but bank risk capacity has been so impaired by 2008 and the several more deflationary events that came after it, they won't lend except only when there is a GSE guarantee. Again, you've never heard about this because you've been told how effective and powerful QE and ZIRP have been. It was all a lie. Banks completely changed how they operated. Their intermediation functions broke down in exactly the way Ben Bernanke had described of the system in the 1930s, even though Ben Bernanke was the guy in charge of the Fed this time around. The guy supposedly wrote the book on depression economics and how it actually manifested, and then sat back and made all the same mistakes as the early Fed in the 1930s had, with the same general consequences. The mechanisms of deflation became depression economics. Here's the punchline, though. This is the reason why interest rates went down and stayed there. Not only during the decade of the Great Depression, despite the New Deal exploding government's debts, but also in the 2010s when fiscal recklessness came roaring back to life. Neither period were inflationary because deflation destroyed too much bank intermediation. The labor market had suffered too much deflationary damage. Money no longer circulated the way it had before, or even to a degree which would allow the economy to legitimately grow. Testifying before Congress in early 2009, Fed chair at the time, yes, Mr. Ben Bernanke said, quote, "If there is one message that I'd like to leave you with, if we're going to have a strong recovery, it has to be on the back of a stabilization of the financial system." And he was absolutely right. But there was no strong recovery or any recovery at all because the financial system was never stabilized. It was broken by deflation. And we know this without question because interest rates never recovered either. They went down by a lot and stayed there for a very long time, just like markets had said at the time. The 2008 crisis was obviously an extreme case of deflation, but that's how it led to the silent depression. There were a few other factors, of course, there always are, but these that I've described to you, by and large, are more than just the gist of it. What that might mean in 2025 is still up in the air. More deflation like we saw in April that takes a significant margin off of employment as well as monetary circulation capacity? Could be. And in the case of April, it was the first time the shadow bank component was actually tested, with the results not being great, to put it kindly. In other words, we don't need another 2008 in order for the long-run economy, and the short run for that matter, to be negatively impacted by an outbreak of deflation. The markets continue to price interest rates that are going to go down to stay. And we have to figure out what that actually means. And all of the symptoms that I've just described to you of a deflationary outbreak, they do fit those circumstances, that path forward, that scenario. So it makes sense to go back and look, what are the mechanisms for a deflationary monetary outbreak to become the long-run future the markets are saying is coming at us whether we like it or not. Symptoms of tighter credits, that's certainly consistent with everything we talked about here, and that's something we saw over in Europe. The details behind the European Central Bank's bank lending survey in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out our subscription over on Substack, link in the description. And until next time, take care.